But okay, so we'll sort of come back to this in a bit. George Heber-Joseph is CEO and CIO at ITI Mutual Fund. He's joining us right now to tell us what he's making of the market. George, thanks for your time. Good to have you here. You know, we had a blowout day yesterday. First up, can you explain what happened yesterday?
I think the global sentiment was positive. The crude also corrected. For India, it was a win-win situation. And there was a big scare on the coronavirus which came in previously.
But why yesterday? What happened yesterday? Because flows were DIIs and FIs combined with some 900 crores, right? And we had a 1,000-point move on the Sensex.
Yeah, I think the sentiment was a bit very muted post the budget, and there was a lot of pessimism which is built in, and a lot of disappointment.
You think it was mainly short covering? I mean,
I think it could be short covering, or I don't look into these details, but I think fundamentally what you have to remember is that we are at the bottom of the economic cycle, and many sectors are trading at either 5-year, 10-year, 20-year low growth rates, and this is not the time to worry about equity markets, is what my understanding is. It is looking very similar to 2003 for me. The banks and non-performing loans is bottomed out. Recently the large private sector bank which has reported the numbers, it clearly suggested that the provisioning is coming down, the non-performing loans is bottoming out, recoveries is increasing, and still they are able to maintain the provision coverage ratio of 75-76%, which looks very, very interesting scenario. One side, people are believing that index is hitting all-time high and there is not much of money to be made, but my belief is that 5 years from now, when we look back, we might say that hey, Nifty probably was at the bottom, and there's a lot of money to be made. I think in the large caps itself,
the economy is at the bottom or the Nifty is at the bottom?
So I think market is at the bottom in the sense I would say that because we are at the bottom of the economic cycle, and as the economy picks up.
But there's a price for everything, right?
Yeah, there's a price for everything. What happens is when the earnings picks up, I can see the earnings picking up in each and every sector apart from probably FMCG. All other sectors are muted earnings for the last 5 years. Even Nifty, for example, Jan 2008 till date, what is the return that Nifty has given? It is 5.5% return CAGR, which is abysmally low compared to its own history, right? Even from the bottom of 2008, if you look at it, is only 11% CAGR. To me, Nifty itself has underperformed its own history, and the broad markets is looking extremely attractive to me, be it mid and small cap, especially small caps, and that's where our eyes are at this point in time.
Okay, I just want to point out that a couple of the observations now that I've gone through the 4A3, the observation 5 stands out quite significantly. Observation 1 and 2 is basically out of because of it relates to out of specification results, which means that there's a long period of analysis which is required generally for out of specification results for most companies. But for the 5th observation, they've mentioned, Prashant, their quality unit has lacked oversight of their quality documents. So they've mentioned specifically on Jan 24, 2020, while they were reviewing and issuing the retrieval and reconciliation of documents, they observed that the firm's booklets for documents, certain documents were in fact destroyed. So 3 booklets were destroyed in 2018. And 2 booklets were destroyed in 2017, and 2 roundabout, and there was some destruction in 2019 as well. So I don't think this is going to go down well with the US FTA. In one instance, the firm was missing a sequence number page of 186 of the investigation, and these booklets are generally used to document the OOS investigations as well. So Prashant, generally these kind of things are always red flags in documents. So I would probably just tread with a lot of caution that even if there aren't any sort of repeat observations here, maybe the street is not too happy with the observations which have been issued. But George, just talking about the pharmaceutical space, a stock such as Dr. Reddy's has come back significantly. You're seeing many other stocks such as Divi's, JB Chemical, all of them at fresh highs. Is that enough of a confidence booster for you, or are you being very selective in pharmaceuticals? Are you skeptical about it?
Yeah, across sectors, you have to be very selective, including pharmaceuticals. And I've tracked this sector for almost 7 years, and I can tell you that it is very stock specific sector. So you have to understand the fundamentals of the companies, where exactly the company is operating and what kind of regulatory challenges the company is facing. For the last 5 years, probably this sector is going through this massive regulatory headwinds, and I think most of the companies are coming out of those headwinds one by one, and the approvals are coming through. The normal course of business is again coming back. I believe that the sector is looking very attractive to me. A lot of companies, large companies in the sector is looking like 2009 kind of valuations, and mostly coming out of the lull period of the repeat observations, or you are seeing that the stabilization of the US markets also in terms of margins, etc. I think it is a very interesting time to look at the sector very positively. There are many stocks even in this juncture in the last 2 years. Probably many stocks have already doubled or tripled in the small cap space in the pharmaceuticals sector itself. So I am looking at various stocks in the sector to be part of the portfolio.
George, thanks very much. Appreciate you joining in and running us through what you make of the market. We'll take a very quick break here.